All right. Well, welcome everyone. Thank you for joining us today. We're excited to be talking to you about the landscape of startup funding. One of our panelists is still joining, but we're going to get started anyways. I am Morvarit Solapur. I am a business and techler, and I work with startups, entrepreneurs, and other businesses and help them with setting up their businesses and with negotiating and drafting all their contracts and tech transactions. I'm also on the board for the UCLA Alumni, and I'm going to be moderating and speaking on this panel today about startup funding. We also have with us Anyani Palani Kumar, who is the managing director of CEO Quest, a coach at Accelerators, and an early team member of various companies, tech companies, including Agile Software and Selectica. We also have with us Jason McDowell, who is not only a Bruin, but a venture partner of a female founder focused WeXR fund, an active angel investor in AR and VR, and a serial entrepreneur. Great. And we have our last panelist who joined us, Melinda Moore. She is also a Bruin, general partner of Moore Ventures and Impact Venture Fund, co-founder of Tuesday Nights, and an entrepreneur and investor. Thank you all for being here today and joining us. And thank you for the audience for also joining us. We're going to have a discussion for about 45 to 50 minutes, and then we'll open it up to audience questions for the last 10 to 15 minutes. Please put your questions in the Q&A and I will read them off to the panelists. All right. Well, thank you again, panelists, for joining us. Today, the first kind of topic I want to discuss is something we've seen in the startup landscape that has been changing. So we have seen that the Uber IPO that was done in the past couple of years was lower than expected. There was the scandal last year with WeWork where it lost over 40 million in valuation in a month. To me, I've seen a lot of more due diligence being done by investors in startups because of these occurrences that are happening. Melinda, what have you kind of been seeing? How have these scandals affected the startup funding space, in your opinion?
Yes. So I would say that the climate in general, there are less IPOs and both Uber and Lyft didn't perform as expected. And so I think investors are taking a deeper dive at really looking at due diligence, not investing with ideas like that are just on a napkin, and truly looking at people that not only just have a concept, but actually have a, a site or a product that's up, that's with customers. And so they can talk to customers and do deeper due diligence. And I think what the WeWork example shows is how important culture is, work ethics. And so I think anybody that's has a startup or an early stage company truly needs to think about the type of culture and the employees and everything that they're building.
Yes, I think those are all very important. Nyani and Jason, have you guys seen anything different in that with these changes with these scandals, or are you guys kind of seeing similar effects?
Yeah, sure. So if you look at that impact of these IPOs, the impact can be felt in three key areas. One is the funding for early stage and late stage startups. Second is the valuation. And then the third one is the VCs trying to raise new funds. Okay. So typically, if you look at anything, what happens in the IPOs, failed IPOs, or the IPOs market is not good, or stock market is not doing well, it typically impacts the late stage startups where they are trying to raise, $50 million, $100 million, funding, more than $100 million funding. So for early stage funding, especially on seed and Series A, since the exit is going to be 6 to 8 years away, the VCs do a lot of due diligence, but the funding may not slow down, right, from the early stage perspective. And then VCs trying to raise new fund, it will slow down because most of the limited partners' money is tied to the stock market. So in summary, it's less impact on seed and Series A, and then more impact on the late stage startups.
Yeah, I think I've definitely seen similar in the early stages. It's not as impacted. Matt asked this question that I'll just briefly address also. When's the right time to start making an airtight diligence trail? And the answer is usually around Series A, usually around the time you get to these really professional investors. That's when they really start to care. Of course, you want to hire people and be someone of integrity and be making good decisions, the entire way. But in terms of that extra level of diligence that I think that these companies like Uber and WeWork are helping to push down deeper into the earlier in the stages, from what I've seen, it's really the Series A where they really expect a really tight diligence sort of process. I think one of the other things, Marjorie, if we want to touch on this, we kind of talk a little bit about IPOs, but the other alternative that we've seen a ton of recently is around SPACs, these special purpose acquisition companies, which is a new name or a not so new name on an old concept of the reverse merger, which is an alternative way for companies to go public. And I think that we're kind of, I'm not sure that we've learned the lesson yet from Uber and WeWork in the current crop of SPAC activity, because we saw it again recently with Nikola, right, which is one of those, it's in a group of companies around electrification, electric vehicles, that was an early SPAC candidate that went public through this sort of reverse merger. And they kind of ran into the same sort of issue with their founder shortly after becoming a public company also. So I think that we're still learning as an industry the balance between greed and eager FOMO and making sure that we're doing the right things for the right reasons.
I agree. I think this is a space that's continuing to change. We're seeing there's been more attention on diligence and something I think that's continuing to grow. And I think, this ties into our kind of next topic I would like to discuss is I've been seeing that COVID has been having an effect on all of this too, and kind of increasing both, the intention to more due diligence, looking for businesses actually having revenue and generating revenue to get funding. And at the same time, it's kind of made pitching easier for startups too, and they have access to a wider geographical base. So it's had positive effects as well as negative effects. Yanni, what have you been kind of seeing with the effect of COVID in this space?
Yeah, sure. So if you look at any successful startup, the life cycle for an exit is 8 to 10 years. So you can expect founders to go through one downturn during their 10 years cycle. Okay? So how did the founders prepare for the COVID-19 impact, and then what was the impact of the funding, right? So I'm a managing director in a company called the CEO Quest. We are a CEO advisory firm. We have 30 startup founder CEOs with a run rate of $500,000 to $60 million. So how did we prepare the founders for it? Immediately in February, March, early March, we called for the meeting with all the 30 founders. And then we looked at what was the pattern in the 2000 stock market meltdown, as well as 2008 financial meltdown. So if you look at that pattern there, what we look for is what was the impact on 3 key areas. What was impact to your cash flow, the revenue, and then the next round of funding. So typically in a recession or whenever there is an unknowns, what you look for is we ask the founders to prepare for a 9-month plan, 18 months plan, and 24 months plan. So first thing what we tell all the startups is, if you're a late stage company, you have to prepare that you are not going to get funding for the next 24 months. That means you need to conserve your cash for the next 24 months. We looked at the burn rate, and then some of the late stage companies were able to cut down the burn rate by more than 50%, because we are pretty sure they're not going to get $100 million, $150 million checks. So for the early stage startups, we also told them there is not going to be revenue for the next 6 months. I'm talking about from the March timeframe. And then 50% of the revenue, they have to project from 9 to 18 months. So we asked them to prepare for 18 months. And then 9 months is, the very positive scenario, saying that, if the economy recovers, V-shaped recovery, then you can plan for 9 months. But the key thing is, for COVID or any other recession, the founder should prepare for an 18-month cash flow. If it's a early stage startup, 24 months cash flow for the late stage startups. So from the funding perspective, what the venture capitalists did was for the March and until April, they did not have any new meetings at all because they're trying to make sure their existing investment, the companies are able to survive. So they worked with only their existing founders where they invested their investment and then made sure they have the cash flow for the next 18 to 24 months. After that, May, June timeframe, they started having a meeting, early stage startups, the founders, they had the meeting. VCs were very concerned whether they will be able to invest money without seeing the founders in an in-person meetings. So, 50% of the funding was back in May, June, August. But in summary, for the seed and Series A funding, right now, in the current month, it came back to the pre-COVID days, COVID-19 days. They do a lot of due diligence because they want to ensure they want to invest in startups where they are going for the right market. The due diligence, they are doing it more, but the funding rate had come back to the pre-COVID days for seed and Series A.
Great, thank you, Yanni. Matt, we will be getting to alternatives a little bit later on in the discussion. But Yanni, that all kind of leads me to my next kind of question as well. One of the things that I've been seeing that's kind of been occurring since the COVID pandemic started is that different sectors in the economy are being affected in very different ways. And there's particular areas that are continuing to increase investment and revenue. Like I'm seeing medtech growing. We're obviously seeing a lot of these virtual ways to connect, like Zoom, that have been growing and getting more infusion of capital in different ways. What sectors have you been seeing investment growing in, Jason?
Yeah, I think those are definitely big ones. There's two kind of, in my mind, two major buckets that we've seen a lot of growth in since COVID. Definitely one of them is around medtech. Like anything around keeping or returning the world to health is an area that's received a ton of investment. And it doesn't matter even necessarily, it seems, whether you're focused on COVID, although certainly that's gotten a fair amount of focus, but maybe anything focused on cancer to gene therapy to anything. That just whole sector has received an increased amount of attention and as a result, more investment. Certainly we've seen other things that are derivatives, around personal protective equipment, around new testing approaches, around even when I really focused on computer vision, augmented reality, that sort of thing, I've seen a fair amount of interest around passive crowd density testing or tracking using computer vision sorts of solutions. How do we make sure that the people, when they are coming together, are still maintaining the sort of recommended guidelines for safe interaction? And even things we think about, these vaccines that we've now seen some great positive test results in phase 3. There's even a massive logistical challenge that still awaits us around how the heck are we going to distribute many hundreds of millions of doses across the country with a vaccine that requires incredibly cold transportation and storage. And that's an area that we haven't yet felt that pain, but there's an interesting opportunity there. But outside of the kind of the obvious more medical stuff is really the ones that we've seen the platform like we're using right now around meetings. But the general category is around how do we live life fully at home? We're very comfortable living life out and about. But now we're trying to do everything that we were doing out and about, all from home, which is everything from meeting people to eating, to shopping, to entertaining, to educating, to going to the gym and other sorts of self-care, to visiting the doctor, whether for physical health or mental health. Like all of these areas have seen extraordinary amount of increased adoption and growth over the last handful of months. There's a platform, kind of talk about this notion of virtual events. I think Morby, you kind of touched on this one, platform called Hopin, which at the beginning of before the pandemic had happened, I'd used this platform before. And personally, I think it was garbage. After the pandemic, very shortly after the pandemic, I had another event that was on the platform and it was marginally better. And shortly later, they raised $100 million on the back of just an absurd amount of increased usage, not because the platform itself had gotten better, it's just that the entire world was now looking for that type of solution. And they were the best of a bunch of mediocre options. But, we've seen everything around this. Zoom, Peloton, video games has been huge. Even Pokemon Go, an app that we saw have a tremendous amount of success. When people were wandering about, they refactored the game a little bit for it to make sense at home. And the report from Sensor Tower recently is that they're making more money this year already in the first 10 months than they did their release year. Like they're already at $1 billion in revenue, which is crazy, right? There's tons of increased activity. So we certainly haven't stopped spending money. If anything, we're seeing people saving more because they're not traveling, and they're spending that on other sorts of tech-enabled experiences. I think maybe the last one I'll mention, which kind of goes back to the first one, which is around telehealth. This is an area that the technology has been around for a long time to enable this sort of interaction with a healthcare giver. It just wasn't accepted. It wasn't accepted because either the healthcare provider or the healthcare systems, the people making the buying decisions, didn't like the idea of it, didn't have enough control over it. But suddenly now there is no other option. If they want their doctors to be safe, they want their patients to be safe. And so they've kind of shifted from this resistance to change to this absolute active desire for change. And so now we're seeing notions of telehealth take hold. And so now the question as we look forward over the next 6, 12, 18 months is, what of this is going to stick? How much are we going to snap back to our old behaviors? And in some ways, we'll be kind of swinging the pendulum the other way. We'd be so excited to be in face-to-face contact with people who are going to create new sorts of behaviors. Certainly some of it will stick. Work from home probably more common. Work from office or dine out. Traveling probably a bit more cautiously or less frequently, at least in the early days, or maybe not. Real estate, whether it's in Manhattan or commercial real estate, are we going to think about repurposing that? There'd be interesting opportunities there. There's probably a huge amount of pent-up demand for certain types of things, even like surgery. If it wasn't related to COVID, you probably didn't get that surgery done. If it wasn't essentially life critical in that moment, you probably didn't get that surgery done. So you got tons of out-of-practice doctors or people retiring early in the healthcare system because they've just been stressed out of their mind and decided this is it, they're done. Anyway, there's a lot that's kind of shifted on the positive side.
Yeah, I think there's a lot of change, and yeah, I think it's going to be a big question moving forward. How much of this sticks? In particular, I can see a lot of medical stuff sticking. I can see some of the other industry changes sticking, but some of the virtual kind of events, I wonder how much of that's going to stick, because a key portion of a lot of the connecting with people is people do enjoy the in-person kind of events. And I don't know if anyone else has thoughts on that, but I think that's going to probably be the biggest challenge for businesses that are operating in that particular space.
Yeah, I suspect we'll see a lot of hybrid activity going on there. For those where it's just about the information exchange, they'll opt to do online only to consume that content that way. But for those where it's really about meeting face to face, building those relationships, they'll opt to go in person.
Yeah, I think that's right. That also brings me to my next kind of topic I want to discuss. There's also, areas and sectors that we anticipate to see increased growth regardless of what's going on with COVID. What sectors do you see investment to be increasing in, Melinda, in general, just moving forward?
Yes, I think so. The area that I focus on is impact investing, and in particular, the low carbon economy. So these are areas I think there was, some doubters in regards to climate change. But globally, when we saw the economies completely come to a stop or a pause, places like Shanghai, Hong Kong, LA had the cleanest air that they've ever had when transportation and manufacturing stopped. So I think some of the naysayers on climate change said, okay, this is really interesting. We can't really deny the impact of human activity on climate. So what can we do to invest in the new kind of green economy? So we've seen people like Bezos and very large billionaires come into the space, giving money to the Nature Conservancy, and actually Apple, Google, the big companies looking at their value chain more, using alternative materials like recyclable aluminum, making sure their plants are more solar. So anything along the line of the low carbon economy. So increased activity in investments around EV vehicles. Also looking at farming and doing more regenerative farming that's not impacting, because soil health is very important for our health. So using AI and robotics around, ag tech is big. Green building is big. So looking at all of the areas where we're having the greatest carbon offset, and then trying to create a new way where when we've turned back on the economy, how can we do it in a way that is more sustainable for people and the economy as well. So I think we're seeing increased interest and investment in the low carbon economy at a global level.
Yeah, I think that's definitely true. And you're seeing it, like you said, in different kind of landscapes. Like not only we seeing it in, farming and in, vehicles and all of that, but there's been a shift as we're all seeing, and even what we see as food, right? Like they're looking at algae and they're looking at other ways to make sustainable ways to meet the food demand across the world. So there is a lot of positives.
Definitely, like Beyond Meat was actually the most successful IPO, so people didn't anticipate that. So looking at alternative proteins, looking at ways that we can do labs so that we move away from the traditional meat industry, which has been highly consolidated, and honestly it's not healthy the way that the animals are created, nor the methane offset. So I think that we're going to continue to see great opportunity in the alternative food and beverage, because oat milk, almond milk, all of that is a huge growth, right? So people are truly turning to alternative forms of eating that are healthier for themselves but also healthier for the planet, and so that creates large economic opportunity.
Definitely. Jason and Yanni, do you guys see any other areas beside, the sustainability, environmental kind of area that you see increasing the next, 5-10 years?
Yeah, so my focus is B2B technology startups. So with the COVID, what enterprise did was they accelerated the digital transformation projects. Okay, so the two technologies where it got funding in the last 8 months is data and AI, and then sensors, IoT, and computer vision. Right, in the healthcare, the remote monitoring device companies, the startups where they were monitoring the post-surgery or the remote health monitoring, these companies got some funding. And then on the edtech side also, educational tech, the remote learning, and then supply chain and logistics also, and manufacturing. These are the four sectors where they saw increase in funding for post-COVID. So for the founders, I also want to articulate one thing, right? Your initial product and market may be different. With the post-COVID, you can also pivot and then get some funding. So I will bring to life one use case. One of my companies, it was a video analytics company. They were doing the foot traffic analysis for retail. That means if you go to any retail store, they can give you the how many people enter that stores, where they spend time, demographic information, and other information. With the post-COVID, with the retail sector down, and then they were not able to get new customers, and then they were not able to get funding. So what that company did was, now they created a new use case for post-COVID, COVID-19 screening, the temperature screening, and then the mask, right, before you enter the building or before you enter the restaurant, right? They had the same solution, but they pivoted it to a new use case. So going forward, if you go to any employees in the company checking, it's going to be a touchless. That means facial recognition, right? And then social distancing. So what they did was they pivoted this use case, video analytics use case, to the post-COVID, and then they were able to close like 30 to 50 customers and then generated $3 to $4 million in the last 6 months. So as a founder, that's what you need to do, right? That if there is not an opportunity in the retail sector, you can go and pivot your use case and then target a different, the different sectors. So that is one key learnings on the for some of my startups.
Yeah, and that's a lot of what I've been seeing, as well. A lot of, clients, startups I work with, businesses I work with, the ones that are being successful right now are pivoting, pivoting to the changing times, being flexible. That's a big thing, I think, that's differentiating companies in 2020. And I also agree, yeah, data and analytics. I have a lot of companies in AI and doing that, or data analytics, and those are big growing areas that I think mass adoption is going to continue to grow in that space. Jason, did you have something to add?
I think those are all amazing areas. I'll throw out two quick stories just around this notion of pivot or taking advantage recently. One of the companies I'm involved with was really focused on training. They're already kind of focused on this remote, how do we effectively train people using iPads and VR rigs? And specifically their audience was healthcare nurses, but suddenly, operating room nurses specifically. And suddenly with COVID, no operating room nurse cared about their tool because all of them were focused on treating COVID, not the sort of higher ordered procedures that they were training their nurses for. And so the pivot was, okay, we're going to now focus on the educational, the surgery, technical education sorts of centers who are in the process of trying to graduate all of these nurses who will eventually go on to be, working nurses. And those centers were coming in person prior to COVID and now need to be remote. And so there's this remote education. It fit more or less with their product. It was pretty close. It wasn't that much of a shift on the product side, but it's very much of a shift on the marketing and go-to-market, how they engage the sort of customer base and change their messaging, that sort of thing. Another was focused on this notion of capturing data for utility. And their initial focus was, how do we build, for like pharmaceutical counters or whatnot, a tool to capture the keywords that are being said. Let's make sure that that exchange of information is including all of the legally required disclosures and that the proper dosage is being discussed, whatever the keywords were in that sort of exchange of information. Post-COVID, nobody does anything in person. So how can they take this this sound and language understanding platform they're trying to build and make it useful? And for them, that was cough detection. Okay, now we kind of have this back end. How do we, when people go back to the office, how do we make sure that the sort of sounds that are in the environment can inform how we can, know whether or not something is going wrong? There's somebody over here that's coughing a ton. Maybe that's a problem, whether that's in an office environment or it's at a remote patient monitoring sort of scenario. Anyway, this notion of pivot, take advantage of the opportunities in front of you is, I think, really key.
Yeah, definitely. I think this is what's going to differentiate businesses, and it's an important part of any business, knowing when you need to be flexible and change your business or your business model. And that kind of brings me into another question that's important for any of these, startups to be taking into account and considering. And that is, is investment necessary for every startup? When is investment necessary? I find that, particularly startups that I'm working with, sometimes, they before they talk to someone, they're in a rush to get investment and they don't really understand their cap table, and they don't understand that they shouldn't be giving, equity to everyone. They need to be strategic about this. What do you kind of see in this space, Yanni?
Yeah, the short answer is no. You don't need funding to build a successful business. Okay? So if you look at the tier 1 and tier 2 investors, on an average, every year, they screen 2,000 companies, and then they meet with the 200 companies, and then they invest only in 20 companies. So the conversion rate from starting the screening to the investment is 1%. Okay. So another statistics is, if you look at the 98% of the companies who got less than $1 million funding, they fail. 80% of the companies which got Series A funding will fail. If you look at any tier 1 and tier 2 investors, 80% of their companies will fail. Only 20% of their startups will return the whole fund, the money for the whole fund. So I'm basically a business and funding coach. I see nearly 500 to 600 startups every year. So if you're a first-time founder, I give a simple framework. What you have to do is you have to bootstrap your business with your own friends and family money. The next phase is sustaining the business. Then you build a high growth business. And then the third category is a high growth fundable business. So if it's a typical SaaS company, for survival, you need to build a 30K MRR, monthly recurring revenue. Once you have a survival where you spend 20% on product development, 10K on your sales and marketing, you go to the 100K MRR where you can sustain your business. And then from 100K MRR to 500K MRR, that is $6 million ARR, that's where you have a growth business. So some of the business are, even though it's a growth business, it's not a fundable business. So if you look at our 30 portfolio companies, 12 companies where they have like $20 to $30 million run rate, these startups are not fundable because it's not a fundable category, right? So the first thing as a first-time founder, what you need to do is first to try to get a 30K MRR, survive your business, sustain your business for 1K, 100K MRR, and then 500K MRR. So if you look at it from the funding perspective, the investors look for three things, right? Or if you look at the institutional investors, they want to have all the unicorn exits. That means they want to invest in a market segment where there is a probability of the exit is more than $1 billion. Okay, so they look for three things. One is funding market fit, founders market fit, and then the product market fit. What I have seen, 80% of the companies, what I see in my due diligence is they are not in a fundable category, right? If you look at the institutional investors, they invest only in 4 to 5 categories in a specific year. If you're not, if your startup is not in that category, you are not unlikely to get funding. And then some of the startups where they got some of our portfolio companies, they didn't get funding, any early stage funding, but they were able to build their business to $25 million, $30 million ARR, and then late stage investors are put in $150 million funding. So the short answer is, build a successful business, and then if it's a high growth business, investors will follow. But don't try to build the startups depending only on the investor money.
Yeah, that's an important point. I think businesses sometimes very early stage just think they're going to get funding right away, and they don't realize, again, it goes to kind of that due diligence that's being increased, is build a sustainable business, build something that has revenue so you can show, investors, this is a business that actually can grow, and it's actually, generating revenue and growing at this point. And that kind of brings me, to another topic we want to discuss is, in addition to kind of building this business and being, making sure it's generating revenue, being creative with pivoting, what are some alternatives that investor or founders can consider for investment besides traditional investment? So it's one of the, for example, equity crowdfunding is an option that's being thrown around. It's something some businesses are starting to use. Melinda, can you tell us more about this topic?
Absolutely. So typical, as he said, typical VCs are looking for unicorns. So a very high growth rate, 100 million at least in revenue. But there are so many other people that have great ideas for companies, whether it's an electric bike, whether it's, something in regenerative farming or a consumer-based product that might not fit the traditional venture model. People can turn to crowdfunding. So there are two different types of crowdfunding. There's rewards-based, where you can raise money to manufacture your product by actually selling. So it's a form of pre-sales for funding. And so that works very well with physical products. So it could be a bike, it could be a watch. Watch companies have raised, $30 million using just rewards-based. And then VCs actually can look at crowdfunding platforms to actually ascertain which companies are gaining great traction. And then in later growth rounds, they can actually do traditional venture. The other thing to talk about is equity-based. So equity-based is where you're obviously giving up a piece of ownership in your company. And so many different types of companies that require capital, whether it's in, renewables, med tech, anything, can actually use equity crowdfunding platforms to raise money. And so I think it's important as an entrepreneur to look at all of the different avenues and pathways to capital, and to truly assess your needs, but also figure out what is really the best fit for the type of company that you're creating and the type of capital that you will need both in the short term and the long term, but also look at, what I would call hybrid models. So whether that's a hybrid model of initially doing rewards and then switching to equity, or you could initially do rewards to build up actually, marketing and an audience and sales, and then do, a Series B growth stage with an NEA or something like that. So I think it's really important as entrepreneurs to understand all of the avenues to capital and how to use them in a way that is going to be both strong in the short term and the long term for your business.
And Melinda, is there, for businesses who are interested in kind of exploring this crowdfunding, is there a stage that they should be in? Like how established, do they have to be in their startup to be able to take advantage of this?
Yeah, so I would say like on the rewards-based side, you have to have an idea for a product. I'm just going to make it up. So, let's call it a high-tech electric bike, okay, with a really good new battery that has better range and, faster than any other bike. So I think you need to have not only the concept for the bike, but you have to have the whole value chain, your manufacturing, understand all of that, know your unit economics, then raise the money and then execute and deliver that product. On the equity based side, it's a little bit different. I mean, you could just have an idea and then be able to raise it with equity. So you can be a little bit earlier stage. It really depends. There's not like one exact formula, but I would say that it's very important as an entrepreneur to truly have as much figured out about your business to be able to raise, the sufficient amount of capital to basically get you to your next stage. So whether that's like you're in, early stage and you want to get to a Series A, or you want to do a VC round, all of those things, you have to really build the business based on what that funding roadmap looks like.
Yeah, I think that's all very important. It's important to kind of put that forethought into the business from the beginning. And I think that ties into my next kind of topic I want to discuss as well. I think it's very common, I'm sure you guys meet founders like this as well, who have not put in that time or thought into kind of building out their business and actually making it a real business. So they haven't, they don't have a business plan. They don't have any idea for how to generate revenue. They don't have founder agreements in place. They don't have, terms of service. None of the things they really need to do to actually be established as a real legitimate business. Jason, what are some of the steps that, new businesses, new startups can be taking to kind of set themselves up for investment and success moving forward?
Yeah, that's a giant one. I think Yanni could give you months of content trying to help you effectively answer that one. There's definitely a lot of the pragmatic stuff around the things that you were mentioning, right? The transition from, hey, this would be cool if we did this, to this is a going concern that I've convinced other people to give me money, in order to help grow, is a massive jump in terms of documentation and organization and thoughtfulness in what you're doing. I think maybe we won't spend too much time on some of the basics there, but a couple of areas that I think are ultimately important. One of them is on the practical side, and the other is maybe on the philosophical side of what do you do once you've kind of gotten the basics in place? Like how do you think about the process itself of fundraising? And it seems a bit mysterious from the outside, but in practice, it looks very much like any other sort of sales process that you've gone through, right? You're ultimately trying to sell yourself, trying to sell your vision, your passion, your opportunity to a group of investors. And you should ultimately treat it like a sales process. And the elements in treating like a sales process are that you identify who your targets are, you really try to understand them and how they think. Yanni noted that a typical investor or firm will focus on only a handful of different areas in any given period of time, any given fund. It's helpful to understand, what it is that firm you're going after is actually investing in, if it matches with what you're doing. It's really helpful to understand that, where they kind of sit in the pecking order in terms of tiers, whether they're high profile or tier 1 versus tier 4 sort of investor, and set up a funnel, set up stages, identify the sorts of material that you need at each stage in that funnel. I'm going to be communicating via email. I'm going to be asking a buddy who knows the person whether or not they can forward me on and ask whether or not I can have the introduction. Like have all these sorts of materials ready. Of course, that kind of the way that the elevator pitch gets used in real life. Have a 5-minute pitch ready. Have a longer pitch ready. Begin to prepare the sort of diligence materials in anticipation of sort of questions you're going to get asked that indicate you've actually thought about it. It may not have to be a full-on business plan, as maybe we learned once at business school, but you have to have answers to the sort of questions that investors are going to be asking around why are you doing what you're doing? Why you? Why now? Really help me understand the problem and help me understand that you understand the problem, and identify the solution that really makes sense in the context of that customer and the rest of the things that customer is thinking about and doing or concerned about, that kind of fits, and demonstrate that this is a giant opportunity that I, as a venture investor, fits my profile. the venture investor, there are some exceptions. Generally, investors, as Nani noted, they want billion-dollar outcomes. They want, at a minimum, 10x. If it's less than 10x, they don't even care. They want 100x. They want the potential for 100x return. And it's because most of their investments, as Nani noted, fail. And the only way you make a positive return they can make a positive return for their investors is if they actually return, something that matches or beats the S&P 500. That's ultimately the benchmark. In order to do that, given that 80% or so are giving, almost nothing back, you need the couple that do succeed to be massive successes. So they're not a bank, right? They're not there to give you a loan. They're not there to give you a donation. They're there to invest in something that has tremendous growth potential, in an opportunity in a market space that's either big or growing, and it has potential to be very big. And that's the sort of rocket ship they want to attach themselves to. So you have to make sure that what you're doing aligns with that sort of source of money, and then treat it like a sales process. Build the relationships, get to know the VCs indirectly by getting to know their portfolio founders, talking to their portfolio founders, to getting to understand that VC, get those introductions to that VC, get work on those, building those trusted or tapping into their trusted networks, whether it's co-investors or advisors that are to that fund. And practice, practice that pitch. That's why it's good to know who's your top of the list versus the bottom of the list. Practice on the ones you don't care about as much, until you understand the sort of questions you're going to get, until you really refine your story, and then work your way up to the more important ones as you do a better job of telling that story. And the other piece of advice I'd note is that you should be selling before you need to sell. You should be making sure that you're building those relationships before you actually need the money. The informational interview that works so well post-business school actually applies really well in investment land also. You can build a relationship with a venture investor who's in your area of interest, but you aren't ready to raise, at least that's what you're saying at the time, and understand what it is they're looking for, what it is they're seeing, who they think would be a good fit for you, and where they think you are in the process. And especially if you have something to return about your own insight or perspective in the market, it's a human-to-human interaction. It's an exchange of value, of information, before you're really asking them for something in which they might have to tell you no. They probably will end up telling you no. But they don't have to tell you no in the conversation. They're much more likely to talk to you.
Yeah, I think those are all very important. I've judged a lot of pitch competition. It is, surprising how many people are not, maybe not surprising. They're not very good at pitching. It's important to practice, like you said, important to take the feedback you get to and kind of work that in. And another thing I find a lot of problems, I'm sure you guys have seen this as well, is there are so many, founders out there who are pitching something and they have not done their market research. So they do not know their competitors. And so, what does the judge ask them? What does the investor ask them? What about such and such competitor? And they're just looking at you with startled eyes, right? So do your market research, that's important. Melinda and Yanni, do you guys have anything to add about any kind of steps founders, startups can be taking to kind of set themselves up for success?
Yeah, sure.
Go ahead, sorry.
If you look at it from the investor perspective, the founder should be able to answer 5 questions. Are you solving a hair on fire problem, business problem, right? Technology is secondary for them. Is it a big problem to solve? Is the total addressable market more than $2 billion? If it's less than $2 billion, the VCs will not look into that segment at all. What is unique value proposition at barrier to entry? Is it barrier to entry on the IP side, or your business models, or is your team? The fourth one is what it takes to build a successful product and team, right? You need to also have a financial model. And then fifth one is at least 4 or 5 competitors should be there. So one thing founders miss is VCs will not invest in a particular company. They invest in a segment. So that should be an ecosystem of startups there. And then you are competing for the VC's money in that particular market segment. These are the 5 criteria the founder should use. Quickly, I will tell you about the process. So this is as Jason pointed out, pitching it to the investors is like a sales process. So you need to start off with 200 to 250 investors. You start screening, and then you will have a 40 in-person meetings or one-on-one meetings, and then you will get 1 or 2 term sheets out of that. So for the founder CEOs, fundraising, is a full-time process for 4 to 6 months. So don't underestimate it. During the time, you need to delegate your day-to-day work to some other co-founders and then focus on funding. So this will take nearly 4 to 6 months for raising money if you're a first-time founder for Series A.
And Melinda, did you have something to add?
Well, I think we should get to the Q&A because I'm concerned about timing. So I think let's do that.
Sounds great. I think we've already answered the first two. The other one is just asking if someone wants to be on someone's board. So I'm not sure if that's an appropriate question for this. It's not general enough. Someone's asking, returning, they're just kind of making a statement that they think that despite WeWork, it sounds like diligence is not a major priority as long as an entrepreneur is in a COVID-related idea. Many still following the crowd, best of mediocre list of options. I'm not sure I agree with that particularly. I think that due diligence is important. I mean, I personally see no founder or startup's going to get invested in if they don't have the right, if they don't have an operating agreement or a shareholder agreement, if they don't have any documents in place, it's not a free for all. I don't know if anyone else, any of you others have any thoughts on this?
I think there's no doubt the diligence is paramount, right? Every one of these investors has a fiduciary duty to their investors that they are taking all precautions that they can conceivably come up with to make sure that it's legitimate, that the investment isn't gonna, they're not just throwing it in the trash can and lighting it on fire. So there are questions being asked, but something Nadi said, investors often invest in sectors, in areas. And sometimes there is some awkward pressures, weird pressures that kind of show up. Like they feel like they need to fill out their portfolio of companies with something in an area. And to this, I made the comment about Hopin. I have no idea. I've never met their founders. Maybe they're amazing, wonderful people who have just really struggled to deliver a high quality product. And now that they have the funding, they can go and do that. And maybe they told that story really well. But from as a user perspective, it felt like the mediocre, the best of a mediocre set of options. But those investors are absolutely doing the diligence and making sure in their minds that it's a good investment and that has the potential to be something really amazing. But we are humans. We are a bit lemmings, especially investor types. We're all a bit lemmings. We're always kind of facing this sort of FOMO sort of thing. And so an objective outside observer will definitely say that, man, that looks very suspicious. Why does that idiot get all that money? And here I'm this brilliant person with this amazing idea. I should deserve some of that. Unfortunately, it's not how it works.
Great. Okay, and then the next question is, they're saying there are many ways to raise capital, but in what industries or scenarios do you think the benefits of funding through a VC for their expertise, experience, or network outweighs the cost of giving away equity?
Yeah, so I will take that. So when you are choosing a VC firm, what we recommend is choose the right managing partner, not a VC firm. Okay, so that is very critical. Who is the managing partner, who is part of your board, who is going to advise you on your startup. That we found out is more critical than a VC firm. So what you need to get is, what the founder should get is a quality money, right? The value what investors will add is their network. They can introduce to their customers. If it's a B2B companies, they can introduce you to 10 or 20 initial set of customers. And then second thing is they also have a huge network for building your management team. So these are the two criteria. In addition to the money, you also need to look at what is their success criteria for the particular managing partner, and then look for how are they going to help in getting your initial set of customers, as well as building your management team. The best reference what you can do is you talk to the other founders who got investment from that managing partner, right? That is very, very critical. Not only VCs are doing a due diligence for you, but you also need to do the due diligence on the firm as well as the partners. So these are some of my recommendation.
I think the decision between to VC or not to VC is one about growth. Is the opportunity you're going after demonstrate and require a tremendous amount of money in order to take advantage of the growth opportunity? If the answer is no, then you probably don't need VC. You shouldn't get VC. It's not worth it. But the answer is yes, this is a really high growth opportunity. If we can move quickly, if we can really buy our customers, or we can buy up a product development team in order to tackle this this opportunity ahead of other competitors, and the opportunity is large enough for that to make sense, then the answer is VC might be your only path to really fully take advantage of that. Although we have lots of examples that's not truly true, but that's a case where the VC money might make sense. And there's some things that are kind of in between. Like there's a concept out there called a firm out there called indie.vc, where on the one hand, the documentation looks a lot like a normal VC, with one important exception is that they are not looking for necessarily high growth. They allow you as a founder to use your revenue to pay off the investment. And so it's not quite like a loan, it's an equity investment, but they're not looking through the same lens that some other typical VCs look through. And so that makes a lot of sense for a company that has some good growth, but they just need that little bit of extra kick in order for them to get there. And some sort of banking product isn't the right product for them. So there's some kind of things in between, but high growth is my short answer to that.
Great.
And I'll speak, I think, a couple important points because I've been an entrepreneur with a couple exits several times. And so I think not only is the managing partner critical, but oftentimes VCs will push the entrepreneur because of just how the market moves. They may push the entrepreneur to pivot to an area of their business that the entrepreneur really did not have a desire to do so. And oftentimes the entrepreneurs will fail. I've seen this time and time again, where all of a sudden the VC has a lot of power because they gave the money, but then they end up directing the entrepreneur into a direction that doesn't work. So I think not only do you have to understand the managing partner, but you have to have a very candid conversation regarding the short-term and long-term vision of the company and how they're going to help you in, extreme market conditions like COVID or an economic downturn, because a lot of VCs panic and they push you into areas and then you just fail. So that's one thing that I would be concerned about, and just to make awareness of. And then the second thing is, oftentimes entrepreneurs, when they go through multiple rounds of venture capital and run a company for 8 to 10 years, because that is the cycle before an IP or you sell the company, you're oftentimes left with very tiny amount of equity, maybe even 5% of your company. I've seen that so many times. And obviously I help a lot of female entrepreneurs and look to invest in diverse teams. And sadly, some of these diverse teams don't have the level of education that, males coming out of Stanford or MIT or Harvard have. And so I think there's just other things that are more subtle things that are there. So I think you have to really understand both the positives and the downsides to getting VC money and what the expectations are and what that's going to be in the long run, because I've seen so many entrepreneurs actually fail or not win when they win because of their relationships with the VCs.
Yeah, I think that's very important. I've seen, founders put themselves out of control, but bad, not reviewing and not, actually negotiating or trying to look at getting counsel with regard to their deals with these financing terms, and losing out on equity and losing out board seats. So these are important things to pay attention to as you go through the process.
Definitely.
Yeah, and I think we have time for maybe one last question. So this last question is going to be, there's often a wide gap between friends and family round to the VC round. Anything that, anyone can say about attracting angel investors?
I'll jump in. So it's the same thing. It's like the sales funnel. So you have to create a list of like 250 to 500 angel investors. You really need to do the due diligence on what their background is, what they've invested in the past, because that's just going to save you as the entrepreneur so much time. AngelList is a really good database to actually, if you don't have access in your own network, being on platforms like AngelList, LinkedIn, being very smart about creating that network, but a network that is 100% going to make sense for your exact vision for the business. And then, it's a sales funnel. And then the thing that I always say is, I never take no as an answer, because you're going to hear a lot of no's. So it might be no right now, But what I always do as an entrepreneur and advise my the investment that I make is to do quarterly updates so that you really show these potential investors the progress that you're making, and you build CRM, which is customer relationship management. And you have to have very strong customer relationship management with angel investors. And then when you do have conversations with angel investors, always ask them for other people to talk to so that you're constantly expanding your angel network. So it's all about networking and networking with the right people and not taking no as an answer.
Yeah, I think
Yeah,
that's
so
great.
I will give you one more resource also. Look at signal.nfx.com. That is a marketplace to connect the founders with the investors. So now they added the angel investors also. That is a good place where you can go and register your profile and then look for angel investors as well as seed and Series A investors there.
Yeah, NFX is doing a nice job in building out that sort of platform.
Great. So these are all very important points. Again, yeah, important to kind of do your due diligence on the angels as well, particularly see if they're experienced, because you don't want someone to come in and try to, tell you what to do with your business that early on necessarily. Again, thank you, Melinda, Jason, and Yanni for joining us this afternoon and having this discussion for our attendees on startup funding. We appreciate the time and thank you all for attending. And this will be the conclusion of our event. Please join us. The UCLA Westside alumni continues to do virtual events. So please keep an eye out for our emails and join us on future events.
Thank you.
Thank
Thanks,
you.
everybody.